Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Thursday, August 24th, 2023, 4:08 p.m. So the markets are now closed, and I'll do a relatively brief market wrap, sticking mainly to the equity markets, but there's several of the comments I want to reply to. There were some good questions and/or comments made, so I want to address those, including Treasury bonds. I mentioned recently that went long Treasury bonds as what I call an indirect hedge to my index shorts that I just recently started scaling back into, and I'll talk a little bit on that when we get to the Treasuries. All right, so one comment I had today, or question, someone asked, are these bullish engulfing candlesticks on the indexes, SPY and QQQ? Yes, they are, absolutely. A bullish engulfing candle, by definition, the body, which is the fat part of the candle, will engulf the previous candle or candles. So this one engulfed the previous two, and yes, those are bearish events. However, my reply, it was, I'll take that all day long. More so, I like today's action. I put a lot more emphasis on that. The fact that it rallied into that this is my daily chart. I had it here at 372.84 resistance. To me, a very good resistance level. It was a key support level once broken. It also coincided with the break of the uptrend line right there. You can see I have multiple uptrend lines here on QQQ. I think you can see. I know this is a little bit of a busy board, but I'll draw them out here. There's one right there. That was the one on I had a couple here. You can see I had a yellow one here, but each sequentially we've taken out each one. I believe this was the big one on the 120-minute chart of NQ, the NASDAQ futures I was talking about, and it coincided with a break of that support level, 372.84, and that was pretty much, it was a high today of 372.74. And so I like the fact more that we had an impulsive rejection, because all along, I was anticipating this rally heading into the end of last week, and those were pretty much the bounce zone, the target zone, and anywhere from that level to the trend line, which is just above, and so we hit that. Okay, so let me talk a little bit more on the bearish engulfing thing. Yeah, it is always bearish when a red candle engulfs, close low. It's a bearish engulfing. However, from experience, I've been doing this a long time, I have noticed when I study trends or reflected on them, they don't mean a whole lot. Here's one right there, the body engulfed. If you go through there, you'll find them within a trend. So my answer was, I like to use bullish and bearish engulfing candles as potential trend reversal sticks. That's what they are. That's what they're meant to be used for. At least I've always used them. I've years ago read up on them, using them that way. In other words, you want to look for them after you've been in a very prolonged, clear bullish uptrend or a bearish downtrend. For example, when you go back to October 15th and 13th, where was it? Right here. You had giant bullish engulfing candles on all the indexes, particularly the important ones, the S&P 500 and NASDAQ 100 right there. That is what you want to see. And that is a clear downtrend. This was the biggest drop in years right there. And and what I added to that is, all the better if you can... excuse me, frog in the throat there. All the better if you can align, if you're looking for a bottom, look for a bullish engulfing. If you can align it with other technicals that make a case to go long, such as, but not limited to, positive divergences, recent improvements in market internals, and key stocks hitting support, such as Amazon, which I think we had back there, some others, things like that. In other words, the more of a reason you can do, especially when you call tops and bottom. If I had a nickel for every so-called expert that's come out over the years and in the financial media and said, you can't call tops, it's impossible, it's a fool's errand, impossible to do. Hey, don't get them all. Sometimes you try to catch a falling knife, you get cut. But here's where I'm going. When you read the comment that I replied to, those are some of the best RR setups, risk reward ratio setups, because again, if you can align, if you can make a decent case in other things in addition to the bullish or bearish engulfing candles, then the reason it's one of the best, single best trades to be made out there is the risk reward ratio is phenomenal. There is really no better RR setup. What I mean by that, so you see a bullish engulfing. Let's say you waited till the end of the day and then you took a position once, or heading into the close. You could see the reversal came early on. We went down the morning and rallied up. I think you can see that there. Here, I'll make it bigger in the video. And so you can see as you're heading into the close, you're going to have that bullish engulfing, and you wiped out the last 3 candles there. So what you do is you go long with a stop below that, because guess what? If you have any violation, even the slightest dip below, technically that's no longer a bottoming or reversal stick because it wasn't the bottom. Doesn't guarantee that you can't, but I usually don't see that, and then you go back up. So again, even if the odds, you want to put it at relatively small, that would be, again, the upside in this case there, had you done that one, and I'm going to show you one more here in a second, that marked the bottom of a rally that was 53% from there. And so your stop loss, even if you bought the close that day and put your stop loss just below that low right there of the day, you risked 5.5% to make, again, playing the game that you sold the high. That's not always so easy either. 52%. So that was a really nice RR. And then that's, again, there's a lot of these have been pointed out, including but not limited to this one back here, the top. That marked the end. Remember, the NASDAQ 100 peaked in advance of the S&P 500. The NASDAQ 100 and most things tech peaked back in November, and that's a beautiful bearish engulfing. I think you can see it there in the video. And again, there was that. We had the divergences. We were short on it. And you had trend line breaks and everything else. Again, they were all pointed out on the 60-minute charts. Those are the ones that are going to get you in early. I think it was like that. And then you had I think there was a wedge there, a little kickback rally, put in a divergent high. I know we had divergence on the daily. So there was 101, or not 101, but a lot of good reasons to be short then. And of course, everybody, meaning the majority, was bullish. So I just wanted to point those out. Didn't really want to spend too much time on it, but at the end of that reply, I said, I'll take it, because the fact that more so it's that impulsive rejection and an absolute, in my opinion, dagger through the knife of the heart of the bulls. Yesterday, even on this site, there was quite a little bit, not too much, of cheerleading. Even some erroneous comments. Somebody said, Randy, how could you possibly expect NVIDIA could go down? I never said that at all. In fact, I was very clear in the video. It was coin toss odds, whether we'd go up, put in that marginal new high, pop after earnings is what I did say and had been saying even since before yesterday. And if you look at NVIDIA, it's got a green candle, but it barely closed positive. This is the day right there. Closed up 0.12. That is a massive buy the rumor, sell the news kind of thing. And as I said before, I've done this long enough. I've seen so many stocks. Apple is notorious for it, topping on just nothing but phenomenally good news, blowout earnings, and then that's often the top. And it's simple. You just can't get wrapped up in the headlines. It's just supply demand dynamics. I mean, when the smart money institutions, they want to buy here when the news is bad, but they can, for other reasons, they see the turn coming, and then this is what they want to sell into. And so if you look at what happened last night, this was the pop. There was a close. They reported earnings. This only shows I can only turn on the last 2 after hour or pre and post market trades. So this is post market now. We're already negative right now. Again, this market's closed. That is, let me turn this on, include post market. So on the day now, every single person that bought into that giddiness, and I told you I hadn't seen anything like it in years when I watched the CNBC folks, getting all excited about the earnings, and again, it's a big pop to be faded. That's all I'm saying. It's not the end of the world. Look, the stock is still just off all-time multi-year highs. So This is not the end of the world for NVIDIA. Sometimes you do see these initial pops get faded, but that was a 9% post-market gain, all of which was faded today. The stock gapped up here today. If you take yesterday's close, it opened up, almost 7% higher. All of it's now been wiped out. So everybody that bought into that hype is now underwater. But again, let's not think too much into it. The most important thing, as I said, I started to compose a post today, talking about the increasingly narrow market breadth, meaning internals, was most of 2023. We'll go down in history. The first 3 quarters or so will go down in history as one of the most narrowest rallies, especially of that magnitude, in the NASDAQ 100 and S&P 500, with just what they called the Magnificent Seven, the ones I mentioned earlier: Apple, Amazon, NVIDIA, and the likes. And then most of those have already rolled over, and it's NVIDIA's last man standing here, really. Alphabet, like I told you, tried to punch out a new high today, and that didn't work out so well. Put in there. There's a top. There's a bearish engulfing candle. So there's a great example. You short Alphabet here today. Still, you could do an after-hours session. I know the market's closed now, but the after-hours session in a stock like this is very liquid. And then you have a stop there, and that's it. Don't think too much into it. Just be mechanical about it. And if you want, it would make sense to maybe a starter position, a half position, and then wait for a break. I'll tell you where the next sell signals or objective short entries will come. A break of the trend line, of course. Big level right here, about 127. And then, of course, as I've been saying now for the last few days, a break of Friday's lows. That's last Friday, on everything. That includes Alphabet here. There's the low. But you'd want to see especially the S&P 500 and NASDAQ 100 take out those lows. Then I think it's going to be that real rut row moment for the bulls and the longs. I think you're going to be see a lot of positioning. So that's what happened today. And again, volatility has been expanding recently. So, no high-fiving or anything, for those short. Today might have been a good day for you. But most importantly, we need to take out, I have dual support levels right here. I have this longer-term trend line off the lows in January. This is really where the NASDAQ bottom. If you remember, it was then, not the October lows, that I got very bullish and long the FANGs and said overweight the NASDAQ 100 and overweight the big techs. Apple and Amazon listed as my 2 favorites, individually overweighting those guys because they actually, even though the market itself bottomed in October, they didn't. You look at the big FANGs, they all didn't bottom then. But when they did in the beginning of January, I had a lot of them, Apple, Microsoft, all these companies either at big support with positive bullish divergences. And so that's why I just want to point out that they bottomed here. And so they were the driver of the rally into 2023. They didn't bottom. They had a lot more downside in October. And I gained some bounces back then, but that was the good time to be in them. So again, I'm showing you that, let's see, Apple already peaked. So that one, we know that's already on the way down. Microsoft had a blow off top right before earnings, highlighted that there. And today, Alphabet now, remember the last of the 2 holdouts are Alphabet and NVIDIA. And so you have a bearish engulfing within a bearish rising wedge pattern. So there it is. So again, objective short entry 1, stop up at there, add on there, and then just let the charts work. Minimum target, minimum. So there'll be stops along the way. There'll be a stop right here, about 115.37, I believe. Then 108. And again, I've said this many times, believe this would mark the end of a bear market rally. It may just be a correction. Maybe the correction's over, maybe not. But let's just say, we go down there. If that's possible. I'll tell you when we get down here if anything changes, and then I think this is going to happen. But as of now, I think we're going to zigzag our way down and ultimately, most likely, take out the previous bear market lows. And so if that is the case, a short here would be money. I mean, it would just pay off big time. But first things first, guys. Let's see what happens tomorrow. Watch these lows. Tomorrow's Friday, so we'll get to see how the weekly charts finalize. You know, when you go back to the weekly charts, this is alphabet here. Beautiful bearish. It's the same bearish rising wedge on the daily, but look at that. Look at that sucker. Negative divergence, just waiting to break. Apple already broke down of its comparable uptrend line, big divergent high, massive, just 110% confirming breakdown candle right there on the weekly. And it's been consolidating on this level here. In fact, it looks on the weekly, probably showed through on the daily, looks like you may have a potential bear flag there. Let's see what it looks like on the daily. I didn't notice. A little sloppy, but I did get at IWM potential bear flag out to you today. Technically, let me turn off the post-market trades, go back regular hours to adjust that candle. It did break down. Let me fix this trend line. It's got to be right there to get nice and tight. So yeah, it broke down. When you close right at the end of the day, you know, you could certainly take, you know, I liked it up here today. I said that's the strategy. Short there, short again on the breakdown. And you could have added it to close, but the safe bet will be to see how we trade tomorrow. If we head on down, the further we get away from this low where we closed today, IWM closed right on the lows, the greater it's going to increase the chance that that's going to play out. And then somebody asked me, again, like I said, there were some good comments. Hey, Randy, TZA just had a big rip recently, meaning with TZA is the 3-time inverse of the small caps from the Russell 2000. So they were referring, I assume, to this big drop, which would have been, again, a rip in TZA. TZA, just turn the charts upside down. You take an inverse ETF, and then you're going to have, instead of a bear flag, you're going to have a bull flag. So their point was, wouldn't that make it a bad time to buy that? And I said, on the contrary, that's the exact reason why I shared this pattern. That's, you know, a bear flag pattern, just like a bull flag in reverse, consists of 3 components. They're very simple, easy to trade. What you want to look for, number one, first component is the flagpole, which is an impulsive move. Impulsive, nearly straight down. Of course, you're going to get some green candles here and there, but you can see this is not, it didn't zigzag down like this all over the place. It was a pretty hard and straight drop. That's component one. Then you look for an area of low-level consolidation. Of consolidation on declining volume, which you had there. You can see on my volume bars, followed by an impulsive breakout, and that's what you had today. If you look closely, not sure if you can see in my video, but you had an increase in the volume bar. The volume had been declining. So those are the components. Number one, flagpole, impulsive move down. Number two, an area of consolidation, which is an upward consolidation that takes the form of a flag, just like that. And you want to ideally see the declining volume on the formation of the flag, which you did through yesterday, right into the high here, and then followed by an impulsive breakdown. And then the measured target, which I did here with this orange line, you just measure the flagpole. So just draw a trend line on your chart and then move it or duplicate it, one of the two. You can either do this and then grab it and move it there, or just right click on it, create a parallel line, whatever you want to do. And you see that gives you the measured target. And that measured target, it never fails to amaze me how often they align with levels I already had. This line right here, if you see, it says 170.33. I've had that line. I created that as a support level back on March 17th. Okay, and so that measured target aligns almost perfectly with the support level that I had there already. Now there is an uptrend line that may come into play. So what I usually do, if I have 2 support levels in close proximity to the measured target, I'll usually cover on the first one just in case the buyers step in there. But I can only tell you if and when if this starts to play out. Look, guys, if we do this tomorrow and it rallies up, then it starts to make the symmetry of this pattern isn't so nice. So it's technically it is a breakdown before the close today, but I'd like to see some follow through to increase any in my short positions, you know, RTY in the small caps. And remember, this is not random stuff. I covered this in a video recently. We had negative divergence, a bearish PPO crossover, the first overbought condition since back in early 2023. I circled all these levels here. These are bearish, high-level bearish PPO crossovers in purple. And in purple here are the tags, the overbought readings on the RSI. And so you had it all. This is simple stuff. You get these conditions, and that's usually where you get these downs. So while the whole world's watching NVIDIA and thinking because NVIDIA blew it away, the stock market must go up. No, that's not usually how it happens. NVIDIA is NVIDIA, and may be the best semiconductor out there. But unfortunately, in a world of indexing, it doesn't matter. NVIDIA, here's the SOX right now. Let me just move this over and I'll show you my watch list. The SOX ETF, look at this. These are the holdings on the right. Every single one. NVIDIA closed up almost virtually flat, 0.01%. That's a flat close. Every other single semi closed down, and some of them just got whacked. I mean, Wolf Speed down 7%. You can see the numbers. ASM, so pretty ugly stuff. Let me drag that back and then just go back to SOX. Remember, that was another one recently. First somebody asked and I gave my opinion, then I followed up in the video. Yes, I think there were SOX were going to bounce, so good time to cover that short. We've been short that. And then my bounce target, if you recall, covered several times in recent videos, was 507.33, which I said would be an objective level to short. And that gift was given to you today. And if you shorted it, let's say right at the 507-ish level, you made just in a single day 5%. And that's not unlevered. If you leveraged up into SOXX, you did twice that, whatever. It's up 10%. So that's that. And on the semis, it's not over yet. Again, the markets are, so far, it's just a correction. And, I will give you that if you are a bull looking for new highs. This is just a correction. Maybe buy this dip. There's a lot of support levels here, a lot of support. So I'm going to just reiterate what I keep saying. A break of Friday's lows and just about everything, especially the important stuff, meaning Apple, Amazon, Microsoft, Alphabet, SPY, QQQ, SOX. Right there, it's going to be lights out because on SOX, you have the primary uptrend line off the October lows, and you have a nice price support as well. There was some reactions over here, so about 472. Here, I'll set an alert. When that alert goes off, it's time to get pretty heavy, short or heavier into the semis, in my opinion. Okay, and then real quick, Treasury bonds. All right, so, okay. I know it's confusing because somebody made a comment that, Randy, that makes no sense. Yesterday you told us you're long Treasury bonds as a partial hedge. You're thinking the market's going to go down. You're short the Nasdaq. So yes, that was for two reasons. First and foremost, as I mentioned, it was a direct play using ZN and ZB Treasury bond futures, which are the same as IEF and TLT. Positive divergence at support or with resistance on yields, which is support for bonds. This is TNX. Again, I went over this repeatedly. This is the previous highs. There it is. Big negative divergence. And so... as far as the markets go, they're in almost a no-win situation as far as being, if Treasury yields continue up. Because as I mentioned back here and here and here, watch Treasuries. Everyone thinks yields are going to drop. They go up, that's going to put pressure on the market. And I said back then it will be not an incremental, not a binary all or none thing. In other words, like one level, but it will be incremental as rates start going up and increasingly bearish for the stock market. And I still maintain that. I think that everyone's hyper-focused right now on rates. So it's almost, if this happens, I put the odds very, very, very low that the stock market will go up. And I even put the odds very, very low that the stock market put the odds very high the stock market will actually go down pretty hard. And again, more of an incremental thing. But increasingly bearish. It doesn't have to, in other words, this move to here, we got what we got now. If we do this, I think you're going to see a much bigger drop in equities. That's my opinion. Okay, so now let's get to how this whole thing works. And I told you before too. I think yesterday I may close this trade out. It hasn't really moved much. It's up a little since I threw it out here right off the lows. So it was up initially. We're positive on where I threw it out the other day. I posted it. I think it was last Friday, was it? No, whenever it was. You can check. Down a little bit today, but that's good because that's what I was expecting. The bonds dropped. Yields went up, which also put pressure on the stock market. So I made a whole lot more on my shorts today than I gave back on treasuries, number one. So that's how a hedge should work, and nothing goes straight up. But then what I had been saying repeatedly regarding yields, and this is important. I think this is very important. There's a twofold scenario here. The charts to me, when I look at the daily charts, more so, maybe it's the weekly. Yeah, it's the weekly. It looks to me like yields, I see some divergences. They could break out and run. And I know a lot of are afraid of that. But I see a lot of big negative divergences been building here on the weekly. So I could see this. Even though I remain longer term bearish on yields, I think in the coming months to years, yields are going higher. Near term, we might get a correction there, and I showed you that would look something. There's the monthly chart right here, and that would look something like this. It could bring us all the way back, for example, to our primary secular bear market downtrend line that comes off the early 80s highs right there. That would be a pretty good pullback. And so here's where I'm going with this. So yes, rising yields are going to be bearish for the stock market, and typically falling yields will be bullish, right? But I said there's a big caveat there, and this is the caveat that I'm hopefully it's going to play out for me. Stock market gets hammered hard coming up soon, and instead of rates going down for fundamentally bullish reasons for the economy, they're going down in a flight to safety because institutions now I know it didn't happen in 2022, and I predicted it wouldn't. We had nowhere to go but up for yields. That's why bonds had nowhere to go but down. It was a guaranteed losing trade, and for the life of me, I think a lot of professional money managers and that hedge funds and pension funds should have lost their job for having a lot of exposure to treasury bonds when yields had nowhere to go but up. The Fed had taken yields down, or not the Fed, the market did when COVID hit down to the bottom. So at very, very, very best, which was an extremely unlikely scenario, rates would have stayed at near zero rates, extremely low rates. It's been long-term, bonds at down minuscule rates here, and you would have collected a paltry 3%, 3.5% interest for the next 10 years on a 10-year bond, right? That's the best case scenario because there's very minimal. You start pushing on a string when you get near zero, right? So the odds tremendously favored that rates would be moving up from that level, and so it was a guaranteed losing investment. Because if you understand how bonds work, when rates go up, the value of the bonds go down. And remember, when you're collecting 3.5% interest per year, bond prices can fall a lot more than that. That's just the 10-year. If I go to the 30-year, it's even worse. But when you go to IEF, here's the example. Those that were buying bonds back when COVID hit at the lows. This is the price of the bond went down 25% in just over a year. Again, so the person or the institution that bought 10-year treasuries here, yielding just around 3% or whatever it was, collected 3% interest but lost 25% on their principal. That to me is, again, it was just crazy. And the banks were doing the same thing. The regionals, they were chock full of long-dated treasuries. That's why we had some of the biggest bank failures in U.S. history. Because when rates started going up, the value of their bond portfolios took a hit. Okay, so now I know I'm digressing a little bit, but going forward, if we do get that, I think we're at a point where we're going to see, instead of stocks and bonds being positively correlated, and they were for the reasons that I said back then before COVID even hit, and then afterwards, that the outlook for stocks and bonds for the first time in a long time was very poor. That whole inverse correlation that they usually have and have had for decades, if not a century or more, that didn't exist. But I think it will. That's where I'm going with this, and that's. Hopefully you understand my reasoning here. And if I need to, I'll throw this hand away. It's like anything. Get rid of the bonds. But that's what I think will happen, guys, based on the charts. I think, if I think bonds have a chance to rally, meaning yields down, not for anything more so for what the Fed may or may not do, but for two reasons: a flight to safety bid from institutions that are moving money, selling stocks. Those that bought Nvidia and Apple in the last couple of months near the highs and realize that they have too much of that, too much risk in their portfolio, they sell those, they buy bonds. Buying bonds causes a price to go up and the yields to fall. And then the other component too is, and this is a big one, guys, really big one, and I'll wrap it up here. Remember, just a month or two ago, everybody suddenly started with the Fed and all the big brokerage houses and investment research firms abandoned their calls for a recession, even a soft landing. They thought the economy wouldn't have any type of recession, and there was that sudden kind of shift. Well, now you're going to hear, and I think you're going to start to see in increasing momentum on this, a call for that we are going to go into recession. We're going to go into it a lot sooner than most expect. And then again, you get that paradigm shift where all of a sudden institutional investors, the big pension funds and whatnot, realize, oh, wow, we may be heading into recession. So what that does, where I'm going with this too, that's another fundamental case as to why rates may go down, because the bond market, long-term bonds, 10 and 30-year bonds are not, those rates are not set by the Federal Reserve. They are set by market forces. And when bond traders expect slowing economic growth, that tends to correlate to lower inflation. And so when they think the market's going to fall, long-term rates will fall. And that's also where you get yield curve inversions. That's why they happen before the recession, because long-term rates start to fall because the smart money anticipates and they can forecast and see that growth will be slowing and we'll be heading into an economic contraction or recession. And then short-term rates start going up or hold the same. Again, you can invert a yield curve by even if short-term rates stay where they are, if the long-term rates fall down below there. And on a final note, I didn't have this chart. This just got me thinking about it now. Just recently, the yield curve reverted or uninverted. And historically, and if you study the yield curve, or you can look this up, it's easy anywhere online, just do a yield curve. And there's a lot of studies show, remember, it's had a 100% perfect track record for, a half century now in predicting recessions. In other words, when the yield curve inverts, when long-term rates drop below short-term rates and treasuries, a recession has always followed with a zero failure rate. But it's not the inversion. It never has been. It comes after that. But as far as a timing indicator, because if you start getting short the minute a yield curve inverts, you're going to go bust. What has always happened is it's once the yield curve uninverts after the inversion, that's usually when the recession is either taken hold or is imminent at that point. And that just recently happened. So there it is, and that's where we're at. So let's see what happens tomorrow. Watch Friday's lows. Definitely today, I think certainly at the open was a very objective time to add shorts, and even tomorrow if we go down, follow through on like IWM for example, that flag's broken. There's just a lot. I do this. There's a gazillion and one things I'm watching. Watch the financials. Remember I told you the other day JP Morgan broke down. That's the biggest bank. It's just clinging on to its, it broke down and it's still a sell signal. If you shorted it, still there was your breakdown candle. Back test one, tried to regain it today, hit the 50-day, got rejected and closed. All that matters on a daily chart is how you close the end of the day. So that is a breakdown with zero violations. That's intraday, doesn't matter. It's how you close the day. So back test one, back test two, and what you want to see now is an impulsive candle moving away from there, a big red candle getting below there, and then the lights out number for JP Morgan, which is 143.85. Big support. And you start seeing the world's largest bank go down, the beloved JP Morgan. That's going to cause some concerns in the financial market. So there it is. Everything's set up to go, but sometimes, you go to the edge, to the abyss, you stare over and the abyss stares back, and then the market does this. So, you can call it an all-in moment now, or you can wait, be safe, wait. There's, again, if this stuff happens, there should be plenty of downsides. I would, I think for me, it's time to be fairly aggressively short, but with dry powder room to add for sure. And then get ready to pivot if all these things start to, if this proves to be a false breakdown, a whipsaw, we start getting back above there. Tech stocks start to rally. And the charts change, then so I already gave you my plan before where I stop shorting and start to sell shorts and consider getting long, and that's right above here, above that downtrend line on QQQ, so it's not too far away. All right, guys, I'm going to wrap it up here, get the video out to you. This has been Randy Finney with Right Side of the Chart. Have a great day.